Hello and welcome to the BDO Accounting Standards Update for the not-for-profit sector for the 31 December 2021 reporting season. My name's Anthony Whyte. I lead the national lead for our service offering in the not-for-profit sector, and I'm joined today by Aletta Boshoff. Aletta heads up our IFRS advisory and corporate reporting service line. And for the first hour of the presentation today, Aletta is going to be taking you through a mountain of changes that are happening in the financial reporting space and that have impacts on the not-for-profit sector. So there is certainly a lot of material to go through there. The last half hour of the presentation will be joined by a couple of four leaders across different service lines in our firm that will talk about emerging issues that they're seeing in their areas, as well as issues to keep in mind as you prepare for your 31 December audits if you've got a 31 December year end, and there's some really interesting issues that will be brought up in that session as well. And sorry, it was obviously remiss of me not to start with the presentation to acknowledge the traditional owners of the land we call Australia. Obviously, the participants in this, we're all quite widespread, and certainly do recognise the traditional owners of the land. During the presentation, I've got no doubt that questions will arise. So you'll see either a question box or a chat box on your screen. Certainly feel free to raise questions as you go. We may not necessarily have time to address all those questions, but we'll certainly look at them post the presentation and would look to come back to you one way or another in relation to those. I will also point out that the presentation was circulated within the last hour or so, so hopefully you've received it. If it's not sitting in your email, you should see on your screen there a place where you can actually download the presentation, and certainly worth downloading because there is a lot of links, useful links within the presentation. But anyway, I'll hand over to Aletta now to take us through the mountain of changes.
Thank you very much, Anthony, and welcome everybody to our update. Now, in today's agenda, it is really jam-packed. You would have seen, and I hope you didn't get a heart attack, 146 slides. The sections that we'll be covering, 10 different sections that I've got on the slides here, and it's all about the latest developments. Now, the intention of 146 slides, which I intend to cover in an hour, so the panel can have their discussion for the last half an hour, is really to give you a good old completeness test. So there's a lot of slides on all the relevant topics, and if one of them is of interest to you and I don't spend a lot of time on it, I've included links to articles or publications so you can find out more. And obviously, you can reach out to Anthony or I or any of our BDO partners and we'll help you with that. So I think I'll kick off and let's fly. Maybe before we fly, I forgot about this one. BDO is really proud to have been a key contributor of the recent Chartered Accountants Australia-New Zealand not-for-profit guide. It was issued earlier in November. And the first part A, is around enhancing performance reporting, impact reporting, ESG reporting, whatever you want to call it. And that's a section where we've prepared the content and updated some of the previous content. We're really proud of that publication, and we're thankful that chartered accountants have given us that opportunity to contribute. And then part B is looking at financial reporting matters. So if you want to look at that, that is in part B of the guide. I've included some links to an article in Acuity where we've contributed again, as well as the not-for-profit guide. It's a really wonderful publication for our not-for-profit clients. So, latest not-for-profit specific developments. So I think the biggest news is that very recently there's been amendments to the ACNC regulations, and the first one relates to the size thresholds. So previously, when we looked at small, medium, large charities or not-for-profits, we had thresholds, which you can see on the slide. I've included the new thresholds. So a small entity would be less than 500,000 revenue, medium between 500,000 and 3 million, and large if your revenue is above 3 million. And that therefore determines whether you are subjected to an audit or if only a review is required, and whether you have to, in the first instance, prepare and submit or lodge financial statements with the ACNC or not. So these thresholds apply from 30 June 2022 year ends onwards, so the 2022 annual information statements. So that has just been finalized. Now, I think as part of that, a question that we've been hearing a lot, and we actually reached out to the ACNC and had a discussion with them about this, is how do we assess and how do we determine revenue when we look at the size test? And the reason for the question is also we've got new revenue standards for not-for-profits. So we've got AASB 1058 around income for not-for-profit entities, and we've got AASB 15 revenue from contracts with customers. So some people had the view that only revenue that are subject to the requirements of AASB 15 would be considered when we look at the size test. And that income that was recognized in terms of AASB 1058 would be excluded. Now, that's not correct, and we've clarified this with the ACNC, and I've included here on the slide some references to the ACNC website and to sections of the ACNC Act that clarifies that. But I think the key thing here is the emphasis on the ordinary activities of your charity. So if you receive revenue or income from your ordinary activities, that would be captured within the size test. Whether you have applied AASB 15 or AASB 1058 doesn't matter. And then the other thing, and this is my paraphrasing, the second bullet point in the yellow blocks, ordinary activities is determined based on the source of an item of income. All right, so if you look at the ordinary activities, how does this not-for-profit or this charity ordinarily get access to funds? You know, for a for-profit is easy. We provide goods and services, and that would generate cash inflows. For not-for-profit, it's different. The goods or services we provide are often provided to people who don't pay for it or don't pay the full value for it. So not-for-profits gets donation or receives donations, bequests, etc., that enable them to provide goods and services to these customers. And the people who receive those goods and services don't always pay for them. So I've put together two examples to try and illustrate what do I mean with ordinarily or ordinary activities in order to get access to cash. So in this example, you can see we provide crisis counseling, and when people come, there's a $100 for each counseling session. We also raise funds through donations and bequests. And then the fourth bullet point is important. I've said there, from time to time, excess cash is invested in term deposits for a short period of time. So I'm trying to flag in bullet point 4, this is not something we do ordinarily. But from time to time, if we have excess cash, we will invest it in a term deposit because that's a smart decision, a commercial decision. And therefore, in this example, revenue for the purposes of the size test would be the money that people pay for the counseling sessions, AASB 15. It will be the cash donations which we regularly, ordinarily receive, AASB 1058. If there are property bequests, those would be included. But the income from the term deposits are not likely to result from ordinary activities because we don't do that ordinarily. It's a little bit haphazard from time to time. So we could exclude those. Now, if you contrast that to another example where we are saying here that the charitable foundation had a bequest or received a bequest of 10 million. And what they do with that 10 million is to manage a portfolio of investments. And from those portfolio of investments, it's distributed as scholarships. During the year, they've sold a motor vehicle and they made a small gain on that. In this situation, for this charitable foundation, if we look at revenue that should be considered for the size test, we would say interest income on the cash we've invested will be an ordinary activity because we manage this portfolio of investments. So all that interest, all that investment income, all ordinary activities, and also the fair value through profit and loss movements on those investments are all ordinary activities. All of that should be considered for the size test. In this example, what we would exclude from the size test is that, sale of a motor vehicle. It was the vehicle of the CEO. We don't do it ordinarily. So that would be excluded from the size test. So what we're trying to articulate here is the size tests have changed. That you have to look at what is revenue for the purposes of the size test, which is different to revenue from an accounting standard perspective. And the key emphasis here is on ordinary activities. Then the other changes to the regulations, as there's some changes around related party disclosures. So the new regulations are clearly articulating that AASB 124 around related party disclosures is now a mandatory standard. So it applies to all medium and large charities. And the first years that it would be required for is actually 30 June 2023 or the 2023 annual information statement. However, already from 30 June next year, KMP, key management personnel compensation disclosures will be required for large charities with 2 or more KMP, and it's disclosed in aggregate only. So please look out for this one. I also wanted to flag with you that the ACNC has issued a best practice guide to improve transparency and accountability. And I think what's important is that first bullet point, there's a recommended disclosure that if 10% or more of your total revenue received from government, or if 10% or more of your total revenue has been received from government, you should disclose the sources of that government revenue. So you have to disclose the revenue from each level of government, the revenue received from each government department or agency, and then also revenue from providing goods or services to beneficiaries who receive related financial assistance from the government. So, for example, from an NDIS should be disclosed. And the reasons is around the economic dependency of the organization on government revenue, and that's a risk aspect, and that should be clearly articulated. And the other thing is to also finally disclose funding received from government that's not yet been received as revenue. So the accounting standards might have said, you've received the cash, it's not revenue there yet, it's been deferred to future periods, let's disclose that. So this is really important. I've also included a link to that best practice guide, so you can look at the disclosures. I think it's always good to look at what's the best practice and try and align to that. We've also flagged that there's some transitional relief for not-for-profits moving from reduced disclosure requirements to simplified disclosures. And therefore, we know that simplified disclosures, as outlined in AASB 1060, is mandatory from 30 June 2022 onwards. And therefore, this 31 December 2021 is actually the last time that you'll be able to use RDR for your December financial statements or December year ends. If you early adopt, so you early adopt simplified disclosures already 31 December 2021 and not wait for 31 December 2022, there are some transitional relief. So you could have a look at what those are. Another thing, and this is, part of the journey to general purpose financial statements, is that there's a requirement for not-for-profits to disclose to what extent they are complying with the recognition and measurement requirements of accounting standards in their current special purpose financial statements. So this is just to be very transparent, very clear. In your special purpose financial statements, what are you complying with, and obviously what not, in particular around consolidation, but all accounting standards. Now, you'll see throughout the presentation, I've included some slides that have links to accounting news articles. So as you know, every month we've got an accounting news. There's always a not-for-profit article or two. The December edition, there are 3 articles for not-for-profit entities. But here are a number of lists of all the latest developments, and you can look at those. Something that I think we should talk about.
Sorry, Aletta, for
Anthony.
jumping in and interrupting. I've just been notified that the handout that we had linked into the presentation is actually from an earlier IFRS update that we did, I think, a month or so ago for the for-profit. So participants might have opened the presentation that was linked rather than from their email and see it is a little different. So we do apologise for that. And I don't know that we can correct it now during this presentation.
I can correct it, and I'm so sorry, Anthony, that is absolutely my mistake. Let me quickly fix this, because I think it's really important to have the presentation in front of you. It's helpful. My mistake, Anthony. I've deleted the old one and I've included the correct one. So
Excellent.
It should now be there, Anthony. Thank you very much.
No worries.
I do apologize. All right. Okay, if we look at transitioning from special purpose to general purpose financial statements, as you all know, we've got the new requirements for the for-profit entities, and I often get asked the question, so what about not-for-profits? Now, my recommendation would be that not-for-profits continue to do what they've done to date. So if to date you've done special purpose financial statements, I think it's good to stay there. Because the AASB has a project advisory panel that's currently thinking about what to do in this space. And they are also looking at the creation of a potential 3rd tier. So a 3rd tier of not-for-profit entities that will prepare general purpose financial statements, but the accounting rules might look quite different. Now, we don't know where that's going to land. So I think it's important to wait and see where it lands before you jump in, and that you also save maybe yourself a bit of time and angst on getting to the correct place. So I would wait for the moment. However, if to date you have been preparing general purpose financial statements and you've applied RDR because you were Tier 2, you will have to move to AASB 1060 for year ends 30 June 2022 onwards. So for that one, you can't wait. But for the move from special purpose to general purpose, I think we should wait and think. If you want to start to think about a transition to general purpose and maybe get your planning right, on our website, we've got 5 steps to a successful general purpose financial statement transition. So it's not just about changing disclosures. You have to do a real assessment, a health check, identify gaps. So please reach out to us if you want to talk to us about that. You might want to start early, but not fully jump in until it's mandatory. I do think the project advisory panel will take another year or two to land on an outcome, and there will be an ED, etc. So there's still time to think about this. So AASB 1060 simplified disclosures. So if currently you were doing general purpose Tier 2, RDR will be withdrawn 30 June 2022 onwards, so you'll have to go to AASB 1060, and then you'll see if you continue with special purpose financial statements. I've added in there that the mandatory disclosures will now be AASB 101, 107, 108, as well as AASB 124, the related party disclosures, and the Australia-specific disclosures in AASB 1054. So there's limited change at the moment for those preparing special purpose financial statements. If you are currently doing RDR and you have to move to AASB 1060 simplified disclosures, we've got a disclosure management tool which can assist you to tailor all those disclosures to a more manageable number of disclosures based on your business. We ask you a number of tailoring questions, and then it generates a customized disclosure checklist. And you can even invite your auditor to this tool to collaborate with you and give you feedback on your approach. If we think about standards applicable or mandatorily applicable for the first time, 31 December 2021, there are 4 new mandatory standards. The first 2 relate to COVID-19 rent concessions. The first standard said that, if you receive COVID-19 related rent concessions, there's a new practical expedient. The second one extends the application of that practical expedient. It creates a few issues on the interaction between the two, and I've included an example to illustrate that. The third standard is looking at interest rate benchmark reform. And that is, if you've got financing arrangements or any contracts in place that refer to an interest rate. So, for example, in Australia, usually we have BBSW plus 2% as an example, bank bill swap rate. Some entities that are part of global groups might have references to not the BBSW, but LIBOR. A LIBOR is being removed, and therefore there are new rules on how do we deal with that removal of LIBOR to a risk-free rate, or the replacement of LIBOR with a risk-free rate. So that's what that standard is doing. It's only relevant if you've got agreements that refer to LIBOR, which should be quite minimal in the not-for-profit space. And then also the fourth standard is dealing with amendments to AASB 1059, which is looking at public sector, and if you're the grantor of a service concession arrangement. Again, don't expect it to be prevalent, but just wanted to put it on your radar. I suspect COVID-related rent concessions would be relevant. Initially, the third criteria in order to qualify for the practical expedient referred to payments due before 30 June 2021. The new amendment, you can see it now refers to payments due before 30 June 2022. So it's a deferral of the time, or it allows this practical expedient to remain active basically for another year. We have included a number of examples. I want to flag the last scenario here. The general principle is, if you were eligible for COVID-19 rent concessions by 30 June 2021, on your previous financial year, and you've elected to apply that practical expedient, you are stuck with that decision. Therefore, if in the current year you are again eligible for COVID-19 rent concessions, and previously you've applied that practical expedient, you will now again have to apply that practical expedient. In the same way, if you were previously eligible and decided not to apply the practical expedient, this year you are again eligible. Again, you cannot apply the practical expedient because you've already made a decision not to use it. So you cannot chop and change your mind on this practical expedient. The third one is interesting, and that is, if you were previously not eligible for the practical expedient, maybe because your lease payments were deferred after 30 June 2021. Now the new standard says you look at payments up to 30 June 2022. So yet you now, for the first time, become eligible. Now you have a choice. Now you can decide, do you want to use this practical expedient or not? So it's only in a situation where you were previously not eligible and you now are eligible that you've got a choice. So that's a third scenario. We've got a publication that you can look at with a number of worked examples that can help you with how to do it. For completeness purposes, I've put in some slides on the interest rate benchmark reform, which I don't think would be too relevant or too prevalent, and then also the changes to AASB 1059 service concession arrangements, the accounting treatment by grantors. The next section I would like to look at is standards issued but not yet effective. Now, as you know, IAS 8 paragraph 30 requires you to disclose in your financial statements those standards that's been issued, it's not yet effective. You also have to estimate the impact that those standards will have on your financial statements once they become effective. So that's just a reminder of that disclosure requirement. I've provided some slides of all of the things you should think about. So there's an annual improvement standard that makes some changes to IFRS 1, 9, 16, and 41. There's a change to IAS 37, and in particular, onerous contracts. So how do we measure the cost of fulfilling a contract when we try and measure an onerous contract? The next one is there's been a change to IAS 16, and that's really saying, you know, if you are producing items while you're constructing an item of property, plant, and equipment, and you sell those items, you can't use the proceeds to reduce the cost of the item you've constructed. You have to put it in your P&L as a gain on sale. Then there's another standard which is quite important, and that is disclosure of accounting policies, and that is becoming effective on 1 January 2023, and it's really providing some information on what would be a material accounting policy and the requirement to disclose material accounting policies rather than significant accounting policies. Now, this standard and this change is alone on a slide to highlight. There are some changes on the definition of accounting estimates. And this is important because an accounting estimate would require a change prospectively, whereas a change in accounting policy and a prior period error would require a change retrospectively. Therefore, we have to fix comparative information. It's important, therefore, to know to what extent an accounting estimate is different from a prior period error and different from an accounting policy. And this can be difficult. So what they're trying to articulate here, that an accounting estimate is a combination of inputs and a measurement technique. And a measurement technique could be an estimation technique. So example, how do we determine value in use of an asset, or expected credit losses? Another part of a measurement technique could be a valuation technique. For example, you could use the income approach to determine fair value under IFRS 13, and you decide to now use the market approach to determine fair value. So that change from income approach to market approach is a change in a valuation technique, which is a measurement technique, and therefore it's a change in an accounting estimate. You change it prospectively. No need to go back. So this actual standard is really important, and I think it's quite useful because we often struggle to differentiate between changes in estimates, changes in accounting policies, and then also prior period errors. We also have a new IFRS on insurance contracts on the way, and the key thing here is please don't ignore the standard because you're not an insurance company. Any entity could enter into agreements where they accept insurance risk, and then they will have to apply IFRS 17. So that's something that we'll talk about again in future. Again, some standards that are making changes on deferred tax, in particular single transaction deferred taxes. Also some changes, the one at the bottom is a problem. Some changes on the classification of liabilities as current or non-current, and you know it's always been a problem area. There's a new standard. That standard originally applicable from 1 January 2023. So the first thing they've done is to defer its application date to 1 January 2024. And just in the last month, the International Accounting Standards Board actually issued an ED to propose amendments to this new standard that's not effective yet. So just hang on, we'll keep you informed. Let's see what happens there. There's quite a lot of unhappiness about this amendment. So I've included some resources again for you if any of those are important or relevant to you. IFRIC agenda decisions, now a bit of an introduction. IFRIC agenda decisions are really important, and it's part of our literature that we have to consider. So quite often when there's divergence in practice, sometimes firms, sometimes entities go to the IFRIC and ask for them to amend a standard or issue an interpretation, etc. Quite often the IFRIC look at these requests and say, we're not going to do anything about it. And they issue an agenda decision, which is basically an agenda rejection. Now, in the old days, they would just say, we're not going to look at this because we think the answer is obvious. These days, to make it more useful, they would say, we're not going to look at this, which means we're not going to issue an interpretation. We're not going to investigate further. We think the answer is obvious, and this is the answer. So these agenda decisions are actually quite useful these days, and we always include them in our accounting news. The tricky bit is, once there's an agenda decision, when do we have to apply them? Because usually they don't have an effective date. The theory is that the answer is obvious. It should have been treated this way all along. We didn't have to change any standard, so you have to implement it immediately. It's really important that we implement them in the next reporting period or the next time we prepare financial statements. So it's important to look at them. Usually, we won't treat new agenda decisions as prior period errors. Usually they are treated as a voluntary change in accounting policy. We wouldn't treat it, usually we wouldn't treat it as an error because there was clearly divergence in practice. That's why it went to the IFRIC in the first place. And now that divergence has been removed, we voluntarily move to the answer that's been provided. So we've included articles on the recent agenda decisions that you could look at. I'm not going to discuss all of them. We also have some e-learning materials that you could look at. If you look at non-refundable value-added taxes, I thought I should flag this one because when you look at leases, there's two approaches on non-refundable GST or value-added tax in Australia GST. The one approach is that the GST should not be part of the lease payment when you work out your lease liability and right of use asset, because the GST in these non-refundable GST items is actually an amount charged or levy amount levied by government, and you apply IFRIC 21. Another approach is that you include it as part of the initial direct cost of the right of use asset, but you can only include the GST on the very first lease payment. So if you've got 60 lease payments every month over 5 years, you can only include the GST on the first payment. Now, our preferred approach is to not include it at all. However, in practice, I often see that non-refundable GST is included in all the lease payments. So this is something that's a problem, and I would like you to consider. And in our IFRS in practice, we've included an example. Now, this is a big problem. Software as a service implementation cost. So I'm going to take a bit of time on this. There was an IFRIC decision already in April of this year. It created havoc for 30 June year ends, but for 31 December, there's an expectation that we would have had enough time to sort this out. So what's the problem? We know that these days, a lot of people are not buying software, but they're actually paying the suppliers of the software for a right to access the software. So we don't buy the software, but we have an ability to access the software in the cloud. And therefore, the right to receive access does not provide us, the customer, with a software asset or an intangible asset. That access is a service that's been provided to us, and therefore, as we pay for it, we expense it every month. The problem here is actually if we incur configuration cost or customization cost in order to access that software. So the software itself is not an intangible asset in our books, shouldn't be. We just get access to a service. But what about these configuration and customization costs? What do we do with that? So when we apply IAS 38, the customer recognizes an intangible asset in relation to configuration or customization of this application software. Can we recognize that part of the cost that we've incurred as an intangible asset? And the agenda decision says it depends on the nature and output of the configuration or customization cost. So ultimately, bottom line, if we, the customer, have the power to obtain the future economic benefits from this configuration and customization cost, plus we can restrict others to have access to those benefits, then we can bring those additional costs into our financial statements as an intangible asset. So that's the bottom green block. Now you can see there, it would be really difficult to argue that we obtain the future economic benefits from these costs and others can't have access to these benefits. Because quite often, the provider of the software would incur these or spend time to customize the software so we could use it, but they keep that, and they could use that for other customers as well. So they customize it for us, and then they say, okay, we've customized it for Aletta. Now we can use that same customization efforts, knowledge, and use it for Anthony or for others. So we can't restrict others from getting access to those benefits. And therefore, usually what I'm seeing is we cannot capitalize those. So this is really a problem. You know, so if an intangible asset is not recognized, what do we do? You know, when do we expense it? If you can't recognize an asset, it has to be expensed. Question is when. So a bit of a diagram that we've put together. If the configuration customization services result in an intangible asset, that's the right-hand side, it's rare, and you have to be very careful how you justify that. But if that is where you end up, because you can restrict access, you would expense it over the useful life of those configuration customization costs. If we're not recognizing it as intangible assets, the accounting treatment depends on who provided the services. If a third-party supplier provided the services, you expense it when the supplier configures or customizes the software. If the actual SaaS supplier who provides the software also provides the configuration and customization services, you have to assess whether the customization services are distinct from the software they provide. If it is, you expense it when they do it. If it's not, you put it all together and you expense it over the period that you've got access to the software. Now, what we're finding in practice, this is a difficult exercise. A lot of entities have just said, whatever I pay on IT, I capitalize to an intangible asset. This is saying you have to go and have a look on what you've done over many, many years, and you have to fix it. ASIC have come out with an announcement around this, and they were encouraging entities to get this done by 30 June if they had 30 June reporting dates, because the decision came through in April. If you've got a 31 December reporting date, you've had more months to do it, so you have to get it done. Now, I've put in an example that was really relevant for 30 June year ends, which is saying, what if you couldn't get the job done before you finished your financials? Now you've got a problem, because you can't have two bites at this cherry. You know, if you've only analyzed part of the costs and fix that as a change in accounting policy, and then you analyze the rest of the costs in the next financial year, you cannot call it a change in accounting policy again. Then it becomes an error. So I would say it's really important that, you know, this work is done as soon as possible, and that you reflect it in 31 December financials. I've got an example there to illustrate some of the difficulties. Anthony, any questions at this stage before I move on to Australian developments?
No questions, Aletta, although the point you were just talking about around the SaaS and expensing those costs, implementation costs, it has caused a lot of discussion in audit committee meetings and board meetings and whatnot. And I know in the not-for-profit sector, there is a lot of investment going on in systems, particularly NDIS service providers continually updating systems and others as well. So it is a very hot topic, that's for sure. And I think, as you've suggested there, Aletta, there is judgment involved. It is not necessarily black and white and easy to work through that decision. So certainly reach out if you need help making sense of it. I don't know whether that's the right word to say, making sense of it, because there's probably plenty that argue well, it doesn't make sense, but anyway, how to apply it.
Thank you, Anthony. That's so true. So if we look at some Australian developments, if you've got bed licenses, I've got a number of slides here. I think you might have to reach out to Anthony or I. There's a lot of complexity. We've written some articles on it. Previously, bed licenses were treated as an indefinite useful life intangible assets and therefore not amortized, but they were subjected to annual impairment testing. However, a government has announced the removal of bed licenses from 30 June 2024. Which means they are now subject to amortization. And because you've moved them from indefinite to a finite useful life asset, it triggers an immediate impairment test as well. So I've included some references to IAS 36 on how do we do this impairment testing at a cash generating unit level, because previously we've argued bed license do not on their own generate cash flows. Usually they work with other assets in a cash generating unit to generate cash flows. So there's a link to the discussion paper issued in September by government around removal of bed licenses. I've listed some of the accounting questions that we've been asked. And I've also included a link to ASIC's FAQ 9D, where they talk about their expectations around amortization, impairment testing. If you've got bed licenses, we've also written an article on it, on what to do, but please reach out. It's a complex area. The other one that I'll touch on briefly, I know Ben Renshaw on our panel will know more about this, is employee leave provisions for casual employees. So previously, we've encouraged you to obtain legal advice and to consider whether you need a provision based on the Rosato case. Where casual employees, although they were paid a loading in the past, in certain situations were still entitled to certain leave provisions, for example, or employee provisions. However, what's happened, and there's an article on that, during the current year, August this year, that Rosato decision was overturned in the High Court. So again, we encourage you to consider whether you still need that provision. There's also been changes to the Fair Work Act, and it's operative from 27 March 2021. They've introduced a new definition of casual employee. It's also been implemented retrospectively to make sure that these casual employees are not entitled to the so-called double dipping. They were paid a loading, and therefore that should remove the requirement to get additional payments, employee entitlements. So again, please look at that. And we've got some articles. Now, portable long service leave, I know Anthony and Elizabeth have a lot of clients looking into this. Again, we've got an article on our website explaining this. So what often happens is a number of people in the not-for-profit space or in particular industries or sectors work in the same industry or sector. They work for different employers, but they stay within that same industry. And therefore, every time they move, they lose their entitlement to long service leave. And there's been a change in Victoria, Queensland, and ACT, where employees can actually keep their entitlement to long service leave. So the long service leave is portable from one employer to another. I would say upfront, it's really important that you go and consider the exact legislation in your particular industry, your particular state, because the accounting outcomes is heavily dependent on the facts and circumstances. What's important, and the key message we want to make here, is you cannot assume that your obligation is zero. So what that means is quite often the employer have to pay the long service leave, but the employer can then also go and get back from a legal or body, get back contributions that's been made by the employees when they worked at previous employers. But don't assume that that means your obligation is now less. You have an obligation potentially for the full payment, but you also have a reimbursement asset to go to this body and get some of it back for those years that they didn't work for you. Now, that liability and asset, you don't have a right of offset. You have to keep them separate. Now, in some situations, it could be that you, as the current employer, based on your legislation, are only responsible for that part of the long service leave that relates to the period that the staff worked for you, and that the employee in its own right can go back to this administrative body and get the rest of the long service leave from then based on contributions made by previous employers. So you have to go and look very carefully exactly what your obligation is and also what are your rights to potentially get reimbursed. So it is complex and it's specific to your particular facts and circumstances. So I've put in an example where I said, if the employer has the primary responsibility, and to me that is key, do you have the primary responsibility to make these payments or not? If you have the primary responsibility, then you have to recognize the provision. If you can then also get it back, you can have a separate asset to try and get it back. So it's important that you cannot offset the liability and the asset. However, in your P&L, you can offset, the contributions. So there's a few examples. I think what's important, we've updated recently, actually, the article that we've previously published in May 2021, and we've included more examples in that article, and to maybe just make it very clear what are the different scenarios that we've seen in practice. Definitely, we haven't addressed all of the scenarios, but I think that would be a good resource. Another thing to look at is reportable payment times reporting, reportable payment times scheme, which is really saying if you are a large not-for-profit, and important, you're not lodging with the ACNC, you might be subject to this new legislation. If you are registered with the ACNC, you are scoped out. So that's good. This is where large businesses have to report to government and indicate within what period of time have they made payments to their small suppliers. So this is to encourage the flow of cash to smaller entities in the economy. So again, we've put in what are the thresholds. And, I think there are penalties involved, but serious reputational damage if you're not paying these small businesses in a reasonable period of time. So you have to disclose what are your terms, how do you usually try and pay them, plus within what period of time have you actually paid them, which is really important. And we've also put in some accounting news articles and a publication, and please reach out if you need help with that. Around COVID-19, it's still with us. So we've got a new publication, Illustrative Financial Statements for 31 December. We've got a COVID supplement. There's a COVID disclosure checklist. Have you considered all the things that should be disclosed? So we want to flag that. And we have accounting news articles that are looking at the accounting treatment of various payments that you could have received from government, whether you've received JobKeeper, whether you are eligible for instant asset write-offs, etc. The next thing that I want to talk about is actually something that is growing faster than I've ever seen any movement grow within the IFRS space, and that is impact reporting for not-for-profits, performance reporting, ESG or sustainability reporting, whatever you want to call it. And I think the business problem here, which is really important, is that stakeholders are increasingly demanding greater transparency about an entity's long-term sustainability. So stakeholders want to provide funds to organizations that will exist in future. Now, for not-for-profit entities at the bottom of the slide, this is particularly relevant because those funders or philanthropists who give you money would like you to demonstrate your positive ESG impact. And in a not-for-profit space, it's often aimed at that S in ESG. Government that often provide a lot of government grants to not-for-profit entities are increasingly also asking that not-for-profits disclose their future sustainability or their ESG impact. And really, in our view, the solution to this and this increased need for transparency is an integrated and holistic approach where you not only prepare financial statements in accordance with Australian accounting standards, but next to it, you also prepare a sustainability report, an ESG report, an impact report. At this stage, it's still voluntary. But I think, the day has come for the two to sit side by side to provide a full picture of your organization so that philanthropists, government, funders continue to provide money to you to do the good work. Now, if you look at ESG, there's a number of articles in our accounting news, but I want to flag here is I try to list a number of the environmental factors, the E, the social factors, the S, which we often see in not-for-profit world, and the governance factors, which is obviously extremely important and actually the starting point. But what I want to flag here is a lot of people are thinking sustainability and ESG is climate change. So you can see very clearly here, climate change is one part of the environmental factors. It's one environmental factor. There's a lot of other things. And maybe for your organization, climate change is not the most pressing and most urgent thing. So just keep that in mind. So there's a lot of information on what all these factors mean. The other thing is there are actually more than 500 possible frameworks that you could use to report against. There's the United Nations one, which I really like. There's the World Economic Forum one, which is looking at principles of governance, planet, people, prosperity, which is just grouping the United Nations SDGs nicely into 4 big buckets. But then the other thing is, very recently, on the 3rd of November, the IFRS Foundation have established an International Sustainability Standards Board, which is sitting next to the International Accounting Standards Board. So we've got these 2 standard setting bodies sitting next to each other within the IFRS Foundation, and this idea to provide holistic standards, holistic communication to stakeholders. So this is very exciting. We are hoping that the International Sustainability Standards Board can bring those more than 500 frameworks together. So this is something that we're continuing to communicate. They've already issued in their first month 2 prototype standards, a general standard which gives you some general requirements, and they say entities are required to make disclosures about all material sustainability related risks and opportunities, regardless of whether there is a specific standard for that issue. So there's a general requirement to disclose these sustainability or ESG related risks and opportunities. And this is what it looks like. It looks like an accounting standard. It's been prepared for finance people. So we're familiar with accounting standards. We can read accounting standards. And then they also have a standard on climate related disclosures. Only 39 pages, the standard, but the examples, the illustrative examples, the technical protocols are 581 pages. This is what it looks like an accounting standard, but then when you look at the technical protocols, it goes on forever. Some really good examples of what would be appropriate disclosures. Next steps, we're expecting an ED early next year and a standard by the end of the year. I've got 1 minute left, and I'm going to use that to talk about, so where do you start on this journey around ESG sustainability impact reporting? Obviously, you start at a governance level. So where do you want to play? Do you want to activate? Is that the next step? Do you just want to be compliant, or do you want to be purpose driven? And how do you make that real and link it to your strategy? Stakeholder engagement. Who are your stakeholders? What are they interested in? So we need a list of all our stakeholders and to engage with them. Materiality assessment is really where we're looking at, on the left side, on the y-axis, the importance of all these matters, all these potential factors, ESG factors. What are their importance to your stakeholders? And on the x-axis, we put in the importance to the business. And then you'll see if this is really important to your stakeholders and it's important to your business, it will be a high priority. And this will look very different for each and every entity. And you will not necessarily measure and report on those items that are low or moderate, but you will measure and report in your impact report those aspects that are of high importance to your stakeholders and high importance to your business. You'll also do a maturity assessment. Where are you currently? Where do you want to go? And we've put together a suggested approach on how you would step through. And Anthony and Elizabeth will see in step 6, this voluntary report could become subject to some level of assurance at some stage. We've got sustainability reporting on our website if you want more information and look at all the accounting news articles. You know, why should you care about these things? Finally, I'm not going to look at feedback from busy season. I'll just put it to you. The regulators are asking questions about make good provision, SaaS implementation costs, leases, you know, the ongoing pain around leases, revenue recognition, impairment testing, government, a going concern, government grants. I've put in some slides to give you some ideas on those topics, things to think about. Remember, please contact me if you need any assistance on lease accounting of anything we've discussed today. Our team, our corporate IFRS and corporate reporting leaders across Australia, Clark in Brisbane, Kevin in Sydney, etc. Our broader team, you'll hear soon from Ashley. So Ashley and I, we are in green because we focus on ESG, sustainability reporting, impact reporting. Please reach out to us. Anthony, I'm exhausted. I've stolen 2 minutes from the panel, but I'll throw back to you.
That's awesome. Thank you, Aletta. There is a lot there, and you do well to cover it in the way you do. So thank you for that. I might introduce the panel now. We have Elizabeth Blunt, who's an audit partner in the Melbourne office, and audits a number of large not-for-profits, and is the leader of the not-for-profit service offering in the Melbourne office. Ben Renshaw, whose name you've heard mentioned already. So Ben leads the people and payroll advisory practice in the Melbourne office, and works a lot with not-for-profits in helping them meet their statutory payroll obligations and meet awards and EBAs, and that certainly is a big area in the not-for-profit space, given the complexities around different awards and whatnot. We also have Tom Fazio. So Tom Fazio leads the risk advisory team in the Melbourne office. So obviously very strong Melbourne presence today. Tom also sits on our national board, and Tom has extensive experience working with not-for-profits around their risk management and business process improvement. And then lastly, you've got Ashley, also sitting in Melbourne, so not beautiful sunny Brisbane, as you can see at my window there. So Ashley is the leader in our corporate reporting team. As Aletta mentioned, is doing a lot of work around this ESG element and helping organisations measure, manage and communicate around sustainability. And talking to Ashley about this yesterday, I think there's a lot of opportunity in this for not-for-profits, and it mightn't be obvious at the moment. So I'll let Ashley expand on that a little later on. So I might just kick off with yourself, Elizabeth. I don't know, I'd imagine obviously out of all that, with what we've seen with Aletta, there's probably things that people need to keep in mind around the audit process and getting ready for the December year-end audit. So have you got any words of wisdom around that?
Sure, thanks, Anthony. And I think Aletta covered a lot of it during her presentation, and some of the key things that we're really focusing on in our audits, especially around any changes, anything that's new, such as leases and the portable long service leave. However, I think the main focus of our audits is continuing to be the application of the new revenue accounting standards, so AASB 1058, the income for not-for-profits, and AASB 15, revenue with contracts with customers. These two standards, were adopted a couple of years ago by all the not-for-profits. However, they have continued, they continually need to be assessed. They're not a set and forget standard. And for not-for-profits, they receive new grants. Many not-for-profits receive new grants annually. And so therefore, we need to reassess those new grants. And looking at the terms of those. So the standards can be very difficult to apply in practice because they include, I guess, when we're looking at them, we need to determine whether the contracts are enforceable. We need to determine whether there are outputs and whether they are considered to be sufficiently specific. And you need to have all of these things in order to be able to recognise revenue over time, instead of the revenue being recognised upfront when it's received. And obviously, I would recommend that you talk to your auditor ahead of the audit. So when you receive these contracts, perform your assessment and document your assessment, and speak to your auditor when you receive them. Don't wait until the audit time because it may then result in a large change in your accounts and how revenue is recognised. So have that discussion up front, pick up the phone and ensure that everyone is on the same page in the correct determination of the revenue. And if it is complex, we also speak to Aletta and her team to ensure that we are giving the right advice.
Yeah, no, that's excellent, Elizabeth. Yeah. I think similar to yourselves, you're probably seeing some clients are doing it well in the way they're documenting it. Obviously, the hard yards were done previously, but as you're suggesting, there continue to be new grants come into place and whatever. So I think, as you're suggesting, it's really important that clients continue to document it in the way they considered it before. So ideally, they should have a template now there that they're following in going through those steps, and that sufficiently specific deliverable seems to be one of the really key points, and to be able to identify in the grant what exactly that is. So therefore you can either measure it across a period or it has to be measured at a point in time. So our experience was there were still some clients that still hadn't got that documentation up to date when they're getting new grants. So I think for any of those with the December year end, it'd be ideal if they did have that documentation in place and they were doing that every time they're picking up a new grant.
Absolutely. And I think because the standards are so complex, I think the accounting standard boards are looking at releasing some further guidance or making some changes to some of the examples in the standard because they're not very specific on the principal versus agent concept for not-for-profits or where there is a termination for convenience clause. So as soon as there is any additional guidance, we will definitely release articles on that.
Yeah, no, definitely. Excellent. Thanks for that, Elizabeth. Ben, mate, you must be a man in demand given all the complexities around payroll and what we're seeing in the not-for-profit space and people picking up historical issues. I'm sure you've seen lots of interesting things.
Yeah, no, thank you. It is an interesting time. I think 4 or 5 years ago, wage theft, pay compliance were not hot topics for anyone actually, but over the last few years, they have become so in hospitality and retail originally, but that's now filtered through to pretty much every industry and area that employs people. I think it's particularly challenging in the not-for-profit space for a number of reasons. And they tend to be they really tend to be, there's a few, they tend to be that the awards and EBAs that not-for-profits operate under are very, very complicated. And that's partly as a consequence of the broad range of not-for-profit services that are incorporated under the SHADS Award in particular. There's a lot in the SHADS Award and it's not particularly well written, it's not particularly easy to understand. So it does give rise potentially to challenges around interpretation of things like sleepovers, whether sleepovers are breaks, how people should be paid for on-call recall shifts, how part-time individuals should be paid, when does overtime kick in, when should leave accrue. There's a whole host of challenges that are sort of wrapped up in the SHADS Award that make paying people appropriately, correctly in the not-for-profit sector a challenge. And I think it's made more challenging actually because we're talking about mission-based purpose-focused organizations that often have challenges around how much they can pay their people, often have challenges around how they find enough people to do the work that needs to be done. Paying individuals is really very important in those circumstances. As it always is for everybody else, but I think in this sector, it's a real problem. I think it links in quite well actually to the S and the G of ESG that we touched on previously. There's a social element to paying people correctly, and there's obviously some governance that's needed around that to get those things right. I think what we see sometimes is because these not-for-profit organizations are so people, mission, purpose focused, sometimes we see that back office and internal processes haven't always kept up with change in the complexity. So while a process might have been fit for purpose 10 years ago to capture time and attendance, to understand rosters, and to have that information flow all the way through to payroll to make sure people are paid properly, as organizations have grown, as more service offerings maybe have come online, as this issue has become more and more front and center, those back office systems and processes haven't necessarily kept up. So that can exacerbate a problem of complexity where it's very difficult really to understand what organizations should be doing and how they've executed on those things in the past. So often we get asked to have a look at these things and go, we think we're paying our people properly, but we want to check because we know it's complex and we know it's high profile at the moment, and we find a combination of challenges with interpretation of awards and EBAs and challenges with processes and systems to make sure the right things are happening with the best will in the world. And because this is high profile for Fair Work and the press, more and more attention gets put upon it. Fair Work are not overtly focused on the not-for-profit sector, but Fair Work really will focus on anything that is generating any noise or momentum. So it only takes 1 or 2 disgruntled employees to put a complaint or a question into Fair Work to get them interested, and then you could be in the situation where you're being audited and looked at. There's also a requirement, generally speaking, to look back once an issue is identified, to look back 6 years from that date. And the challenge with that obviously is that a relatively small individual problem, when you look at it for your entire population for a 6-year period, can sort of mount up pretty quickly. So it is a challenging time in a space, and I would encourage all not-for-profits to really make sure that they are periodically looking at their obligations under awards and EBAs and really being able to satisfy themselves, both from management and board perspective, that those obligations are understood and being met.
Yeah, no, that's a really good point, and a really good point about a small thing can grow into a big thing, particularly when you've got to go back the 6 years. And I think sometimes maybe clients think, oh well, we've had the external auditors through, that's going to pick those things up, but there's so many small things around the payroll, and obviously external auditors, Elizabeth and myself like to refer to materiality. We need to refer to it. to keep the audit cost effective. So there is a lot more deeper dive that obviously can be done in relation to payroll to make sure it's being done correctly.
And just on that point as well, I think interpretation changes over time too. What was common practice as an interpretation of an award clause, for example, 5 years ago, may have subsequently been challenged and sort of overturned, if you like, and now the correct Fair Work interpretation is somewhat different. And again, whether a sleepover is a break or not is a really great example of that. For disability service providers and the aged care providers in particular. So it's not static, it's far from static. So even if you were sure 2 years ago, it certainly pays to look again at some of those areas.
Yeah, definitely. And Tom, I suppose this kind of does really tie in a bit with your space and the whole risk management piece. I'd imagine obviously boards in particular would be very keen, or often would be keen to talk to you around that.
Yeah, it's an interesting question. We're seeing a lot of work at the moment. We're working with not-for-profits where we're trying to update or create a risk appetite statement, which is really essentially a communication device that the board provides to management on levels of risk tolerance that they're allowed to engage in for their day-to-day activities. And what we're finding is there's organisations that are either looking to initiate a risk appetite statement or organisations that have one and it doesn't work for them. And where we find it doesn't work for them is they have a generic motherhood statement. And what we've found success in is graduating a risk appetite statement to really granular levels that can be adopted by management into categories that make sense for management and also the board. That's, for financial type risks, this is a risk tolerance type issue, or for people type risks, this is a risk tolerance that we'll accept, and it might incorporate some of the stuff that Ben said about, wage theft and the like. So I think you'll find that when we move into that granulated risk appetite statement, it gives a really good linkage not only to the purpose of the organisation, like Ben said, that mission and purpose is quite important for the not-for-profits, but also creates a really good nexus to the internal audit assurance piece. So you're delivering valued internal audit that makes a lot of sense. So if you're outside tolerances of a risk appetite statement at a granulated level, you can focus and hone in your internal audit spend and activities, if you like, and effort to those areas that put you back into that tolerance for regime. So the boards and audit committees can feel comfortable that management's according to what the board has set from a risk appetite statement. So, and it's very different for every organisation. So all tolerances are different. So it's really interesting to see, even within the not-for-profit sectors, there's different tolerances and appetites right across the sector. So it's really interesting to see.
Yeah, no, that's exactly right. And Ashley, ESG, you hopefully, I imagine a lot of people scratch their heads, say, yeah, what's this and whatever. Quite interesting. One of the large not-for-profits I look after in Brisbane here at their AGM this year, and there was discussion among the members about, well, where's our sustainability reporting, and we're going to look at that next year and whatever. But it's certainly, from my mind, is very relevant to not-for-profits, and we were discussing it in the office recently. And I'll just cite a couple of examples, because I'd imagine maybe some people on this presentation be thinking, well, how does it really fit in with my not-for-profit organisation? So some of the things I was thinking of, and I'm sure you're actually going to come up with things that are more relevant, but from an investment point of view. So there's a lot of not-for-profits that have a very big investment portfolios. So even to the extent that they're then looking at, say, if they're in equities or whatever, and the ESG statements of what they're investing in. So that becomes relevant. And then a lot of the not-for-profits that we work with do work overseas in developing countries, and there are sort of governance issues around fraud and bribery and all kinds of different things. So there's a whole lot of elements around that, as well as, like, obviously those that might have a lot of shops, use a lot of energy, building new buildings, and whether their buildings are built in a sustainable fashion. So there is a lot of touch points. But you definitely understand it better than myself, mate. So looking forward to hearing from you.
Well, I think Anthony, some of the comments you make are absolutely spot on, and those things are at the forefront of what a lot of people are thinking. To try and describe it in its simplest terms, I think what we're really seeing is this whole ESG movement, which is everywhere, which everyone knows, it's largely being driven by one of three things, right? It's when it boils down to it, it's access to capital, access to markets, being consumers, and access to talent, being people. And so I think you mentioned both of those just in your comments there. But yeah, access to capital is going to be an issue, like you say, for not-for-profits that have investments in various portfolios. But specifically, it's affecting large listed organisations that access the capital markets on a regular basis. But anyone that's investing needs to have some kind of lens, sustainability lens, on the performance of their capital, where it's going and what it's doing. The second one, access to markets, is a really big issue as well, and that's largely driven by consumers. And the FMCG industries are being heavily affected by this at the moment. What kind of recycled packaging have you got around your products? Those types of things. The supermarkets are being driven to do this more than anyone else. Then access to talent is a big issue as well, and particularly for people-based businesses like ours and like a lot of other professional services. But it's one or more of those drivers that is doing a lot of this. I think what's really interesting for the not-for-profit sector is it, like any other organisation, like any other for-profit business, like any other government organisation, it is going to have to respond to external stakeholder concerns and internal stakeholder concerns about its ESG performance over time. So every organisation will need to respond to ESG expectations. The other really cool thing I think that's going on here is there's a really good opportunity for not-for-profits in this space, because if you look at the three pillars, E, S, and G, a lot of organisations are focusing on how to reduce their environmental footprint, no problem. A lot of organisations are focusing on how to deal with governance issues and improve governance in their business and in their community. The S is the opportunity here, right? And so, and I'm generalising a lot, but what a lot of organisations are doing is under S, they're saying, okay, we've got some kind of social responsibility to do the right thing by our employees, do the right thing by our supply chain, and do the right thing by our community. And it's the community one that they struggle with. And where a lot of the corporates are going with this is they're saying, okay, we need partnerships. We need partnerships to help us have an impact on our community. And they're typically turning to not-for-profit organisations to partner with, to be able to deliver what they want to deliver under the S pillar of their ESG performance. So a classic example would be, many of you will know of a lot of the big listed property funds. So Investor is one of Australia's largest owners and managers of commercial property. You read Investor's ESG report. They talk about their Activate in the Community program, which is under the S pillar in their ESG framework. They're focusing on positive social impact in the communities that they operate in. Now, they own a lot of buildings in CBDs around Australia. So they say, well, we're specifically targeting social issues in major Australian CBDs where our assets are. So they're looking at things like homelessness, youth at risk, natural hazard resilience, right? They have no skills in any of those areas. And so what they're saying in Cruikshank is, we're happy to hand out money, time, and resources to organisations that can help us deliver community outcomes in those spaces. So if you're a not-for-profit that can address homelessness, youth at risk, natural hazard resilience, then you're likely to have someone like Investor come knocking on your door and say, hey, are you interested in a corporate partnership with us? And so they're partnering with the Property Industry Foundation, Dress for Success, Share the Dignity, a whole bunch of other not-for-profits to deliver some of these programs. So I think the opportunity for not-for-profits here is to think about the services that you deliver to the community and what corporates might be interested in partnering with you to help deliver what they see as some of their obligations in that area. And that ultimately comes from them as time and money. So you'll get dedicated resources from the corporate, and they might make donations to your business as well. I think that's a really exciting opportunity for not-for-profits.
Yeah, that's a really good point, Ashley. And I imagine a number of those watching this presentation at the moment, large organisations, they'll probably have someone that looks after that corporate relationship and partnerships and developing those. And for maybe people on this call to go and have a talk to them and say, hey, around this ESG piece that you're hearing a lot of under the sustainability, corporates might be turning their mind to it more, to partnering. There might be more opportunities in this space over the next few years, and yeah, get them thinking about that. So
yeah, and that, if I've got a couple more minutes, Anthony, I'll just make one other point, if that's all right. The other thing that we're seeing a lot more of is a greater focus on impact reporting, and this specifically applies to not-for-profits as well. And I mean, I think the reasons that are obvious, and Aletta already mentioned it early on in some of the material that she covered, but you know, there's a growing competition for funding for not-for-profits, whether it be for government grants or from other philanthropic sources. But what is becoming harder and harder, I think, is for various not-for-profits to be able to demonstrate the impact that they're having on the community through the provision of their services or otherwise. And so they're investing more time and energy in being able to more effectively communicate what they do. And so, you know, if you can imagine, there's this kind of scale of features, benefits, value, and all not-for-profit organisations can explain what they do. They can explain the features of their service. Many not-for-profits can explain the benefits that they deliver to the community. And the ones that are doing really well in this space is they're able to actually quantify the value of the benefits that they deliver to the community. And so, yeah, they're getting a competitive advantage in the funding race, because they're saying, you know what, for every dollar you invest in us, we're saving the community $3.20, $4.50, $5.60. And it's a really easy thing to think about, and it's a really clever way to communicate value. So there's a really big push to create effective impact reporting as well that we're seeing a lot more of.
Yeah, no, that's exactly right, and that reporting is really important, and probably not necessarily easy to do, but kind of, I think across all our service lines, and this is what I'm seeing in the industry generally, is data. Data is so critical. So from a payroll point, being able to pull the data apart and use fancy tools to do that, from an audit perspective, using those data analytic tools more and more. So we're looking at the whole population rather than a sample, and the whole risk side of things and the forensic side of things. Just the tools that we're using have developed so much over the last few years that it enables us to do a lot. But then that piece around gathering data of the impact these great organisations are having, and then use that to communicate with, is very powerful. So that's fantastic. So unless there are any other comments that yourselves want to make or thoughts that you want to share, not really. Ben wants to see what the cricket result is. They are still playing, Ben. The sky's blue here. It is, might cloud up a bit though. Look, I will say thank you to yourselves for taking the time to share your insights from your different fields, and obviously, Aletta, the magnificent effort you put in pulling together all that information. So, and for the participants, the people watching this, I'd imagine there may be a lot of questions that came up as you were watching this, because there was a lot there, and it'll impact you in different ways. So certainly feel free to reach out to ourselves. You'll see our details there in the presentation. Even though we have a strong Melbourne contingent here at the moment, each of these wonderful people have counterparts in each of our different offices as well. Plus, as we know, the borders are no barrier now. We can sit wherever and work wherever. So yeah, so please feel free to reach out. So thank you for giving us an hour and a half of your time today. I hope it was valuable, and we wish you all the best for the festive season, and hope you have a wonderful time and a safe time with your families. Thank you.
Thank you. Bye.
Thank you.